Welcome to Tony Byrne's View with news you can use. Tony has over 32 years of experience as a chartered financial planner and wealth manager. Tony's passion is to help you retire early and live the life of your dreams with no financial worries. Now to today's episode.
Is SPAC the new South Sea bubble? So what is a SPAC? A special purpose acquisition company, SPAC, is a blank check shell company designed to take companies public without going through the traditional IPO, in other words, stock market flotation process. SPACs allow retail investors to invest in private equity type transactions, particularly leveraged buyouts. A SPAC essentially goes through the IPO process on behalf of another company. It raises money from investors for the purpose of acquiring or merging with a yet-to-be selected company. SPACs have no product, operations or revenue to speak of. A SPAC is a high-risk but potentially profitable way for individual investors to get in on the ground floor of a potentially big and new stock. One can look at a SPAC as the reverse of a traditional IPO. A SPAC goes public first, usually with a highly regarded executive team able to raise money from large institutional investors with the intent to acquire a private company to put in its shell within about 24 months. Funds raised via such blank check deals have totaled a record $70 billion last year, a remarkable five-fold increase from the previous year, according to Goldman Sachs. SPACs have a poor record of delivering returns. Of 107 that have gone public since 2015 and executed deals, the average return on the shares has been a loss of 1.4%, according to Renaissance Capital, a research and investment management firm. Since investing in blank check companies carries a higher risk than many other types of investments, it's important to make sure that your portfolio isn't holding too much of this kind of asset. As compared to traditional IPOs, SPAC IPOs can be significantly quicker. Due to its lack of fundamental operation, both financial statements and prospectus filed during a SPAC IPO are significantly shorter and can be prepared in a matter of weeks, compared to months for a traditional IPO. The problem with the blank check companies is that there are shades of the South Sea bubble about them. So what was the South Sea bubble? In 1720, the whole of England became involved with what has since become known as the South Sea Bubble. In 1720, in return for a loan of £7 million to finance the war against France, the House of Lords passed the South Sea Bubble, which allowed the South Sea Company a monopoly in trade with South America. The company underwrote the English national debt, which stood at £30 million on a promise of 5% interest from the government. Shares immediately rose to 10 times their value. Speculation ran wild and all sorts of companies, some lunatic, some fraudulent, or just optimistic, were launched. For example, one company floated was to buy the Irish bogs, another to manufacture a gun to fire square cannonballs, and the most ludicrous of all, for carrying an undertaking of great advantage, but no one to know what it is. Unbelievably, £2,000 was invested in this one. The country went wild, stocks increased in all these and other dodgy schemes, and huge fortunes were made. Then the bubble in London burst. The stocks crashed and people all over the country lost all of their money. Porters and ladies' maids who had bought their own carriages became destitute almost overnight. The clergy, bishops and the gentry lost their life savings. The whole country suffered a catastrophic loss of money and property. So a salutary lesson to us all. It's little wonder that some people are asking whether or not SPACs or blank check companies are the new South Sea bubble. Only time will tell. Not all SPACs are bad though. It's just important to be vigilant and do your homework before investing in one. For example, Juvenescence, one of the largest holdings in the CCM Intelligent Wealth Fund, is intending to use a SPAC to float on the New York Stock Exchange in the next 6 to 12 months. We are confident that if this happens, it will be one of the better SPACs. So the moral of the tale is to research SPACs carefully if you're tempted to invest in them. If it sounds too good to be true, then it probably is. You know it makes sense.
Thank you for listening to today's episode. If you enjoyed it, don't forget to share it with your friends and family. For more information, head to www.wealthandtax.co.uk.